I remember my first 3 years as an analyst. I don't think I had a single day off. It was 365 times three. Seriously, it was insane. I'm not sure that's still the case in investment banking, but it was, there was no mandatory leave. It was mandatory stay.
Hello and welcome. My guest today is Sachin Khajuria, author of 2 and 20, How the Masters of Private Equity Always Win, which has already sold over 50,000 copies since it came out less than a year ago. Sachin is a former partner at private equity firm Apollo Global and is also an investor in funds managed by Blackstone, Carlyle, and Goldman Sachs. In our conversation today, we talk about how he broke into finance, why he decided to write 2 and 20, the private equity investment process, how he would invest $1 million in the current economy, skills you should develop, lots of advice, and his future plans. So let's get right into it. Sachin, thank you so much for joining us. It's a real pleasure having you. I want to start today's conversation by talking a bit about all the craziness that's happening in the banking sector right now. Silicon Valley Bank has collapsed. Credit Suisse is being bought by UBS for pennies on the dollar. What's your reaction to all of this, and do you think it's going to get much worse?
So first of all, thank you for having me. It's great to be on. I think two things are happening. I think first, we're looking at the unwind of a very unusual period that a lot of people, particularly young professionals, got used to, grew up in. And that very unusual period was one of low interest rates and low inflation, artificially kept at those levels financial crisis. And just as things may have changed again, and QE would have stopped, and purchases by central banks would have stopped, we had COVID, so it had to reset. So something like $8 trillion have been pumped in by the Fed and central banks. And so when you have that rush of liquidity over this time frame, from the financial crisis through to now, essentially, you inflate asset prices. You only need to look at a correlation of the S&P and the Fed balance sheet, and you'll see that they both kind of grew more or less together. And so as that has started to unwind, you have cold turkey. And it's unwound because it needed to unwind. And that's because of the second thing that's going on, which is shocks. Shocks to the economy don't just stop because they're inconvenient. You have COVID, which is a completely exogenous shock. You may have, sadly, some geopolitical events or terrorism or something else like that. You have now, obviously, the terrible war in Ukraine. And so the combination of these things means that just as financial conditions are getting tighter, we have shocks that make the situation even worse. And, the unintended consequences, or maybe just the consequences of this tightening, are that, some institutions which were probably doing the wrong thing, banks, as they have deposits. Those deposits are pretty mobile. And if they're making investments which they can't unwind quickly, they can be in trouble, right? They can be a run on the bank. So when you have institutions that are not really doing things that they should do, maybe lending too much in one area, taking too much of a bet in another area, and then you meet this iceberg combination of an unwinding of easy financial conditions and external shocks, you get these crashes. And we should expect to see some more of these, hopefully not quite as spectacular as we've seen over the last few days. But we should expect to see more of these before things stabilize.
So say you were in charge of fixing this mess. What would you do?
That's a huge question. I'm not sure I'm the right person to be in charge of something like this. But I think, I think they're more or less doing the right thing, which is looking at the data and trying to calibrate all these different. You have the goal of financial stability, price stability. Financial market functioning. You have the goal of employment. These are very difficult things to triangulate, very difficult to put in balance when you're constantly dodging all these bullets, all these shocks coming in. And so I think they're more or less doing the same thing. Could you say that they should have started to raise interest rates a little earlier? I think in hindsight, that's probably the case, right? And could you say now that they've slammed the brakes on a little too hard that probably looks like the case too, because they haven't really waited to see what the impact is of these rates rising. And I've said, several times on Bloomberg and other platforms that it's only when we have these elevated rates for 6, 9, 12 months will we really be able to shake out what the implications are. In the beginning, it looked like the consumer, for example, could withstand higher rates. That's because they hadn't been in place for very long. And a lot of consumers have built up big buffers of cash in COVID, right? Once they start to run out, once you start to pay all those interest payments over many months, over a year or so, and you realize that you just can't afford it anymore, that's when you start to change your consumption patterns. That's when businesses start to behave differently. And so, I think they're more or less doing the right thing, to be honest. Hindsight is a wonderful thing. But if I was to look at, one slightly different perspective going forward, I would say that I would not lose sight of just how damaging it would be to really severely inflict damage on the economy through further financial instability, through unemployment. When you trade that off against higher inflation for slightly longer, it's a very tough judgment call. Right? It's a very tough call, but we've seen a few unintended, consequences already. And I think we just think about, if we've been rising rates have been rising so fast, should we be tempering those rates increases just to see how things play out and look at the data before we continue that program as aggressively as we have?
Yeah, I feel like we can talk about the economy for another 2 hours and still not get anywhere. But I do want to go back to Sachin Khajuria. So let's start from your childhood. What were you like as a child?
Playful, I'm told. I don't have a perfect memory. It was quite a long time ago. But playful, curious, I think lots of little kids. I was a little bit young in the year. I was born in the summer. And so as a result, you have to learn to be a little bit robust because you're the youngest kid, right, in the class. But I'd say it's an interesting question. I'd say those characteristics: curious, playful, and try to be robust.
How did you become interested in finance? Was it a point in time, or did you sort of always know you wanted to break into finance?
I kind of always wanted to do it. Neither of my parents did it, but they had a lot of friends in the business. Their background was kind of, diplomacy, science, medicine, between them. And so, they had other friends who were in different professions, doctors, lawyers, engineers, that kind of thing. And what I learned from their friends was, it's a good way to learn a lot about business, and be at the coalface, be where the action is, really learn about how to analyze businesses financially, and really get to understand them without going through 20, 30 years, up the industrial ladder, right? And so it just appealed to me as something I really wanted to do. I had no idea how long I'd do it for or if I'd be any good at it. But I wanted to try it, and it seemed like an exciting, fun place, to work on Wall Street, to be involved in, mergers and acquisitions, to really sort of try to understand how these companies can change so drastically. One company buys another company, it raises equity, it raises debt. What does that mean? How does it work? What's the impact on consumers? What's the impact on, other industries, on competitors? It just seemed like if you're interested in business, it seemed like an exciting place to be. So I'd say relatively early on. And then, of course, the difficult part is, getting in and having someone give you that opportunity.
So how did you break in? You started out in investment banking. What did you study in college? How did you get there?
So, like a lot of people who go into investment banking, I read economics. It's interesting, we did almost no finance. I did it at a school in England at Cambridge, and at the faculty then, there was very, very little finance for undergraduates. It was much more about macroeconomic theory, microeconomic theory, mathematics, applied mathematics. It was sort of at the foundation level, as opposed to going to a school that has a rich finance tradition, like a Wharton or something like that. But I got enough of a taste of the economics that would be applied into financial economics and then into finance to get a decent grounding. And, all the banks would come and present because they wanted to, hire undergraduates as soon as they graduate to start on the analyst program. So that's basically how I approached it from an academic standpoint. But I got to say, the economics that we did at college, at university, was pretty sort of detailed theory, quite heavy stuff. Whereas obviously what you're doing as an investment banking analyst is much more practical and is focused on very specific applications like LBOs.
Let's talk about your book, 2 in 20. You're a recently published author. You've already sold 50,000 books. Congratulations. What inspired you to write 2 in 20, How the Masters of Private Equity Always Win? And then what is the most valuable thing or lesson you got out of writing it?
So I always wanted to tell people a bit more about this industry. I think that a lot of people don't really understand how it works, even if they've heard of it. In some cases, even if they interact with it in their professional lives, or they've come across that maybe their employer is owned by private equity, or they know somebody who works in private equity. Not enough people understand it. And I think that with that sort of motivation, today, I guess you could call it the democratization of finance, really getting everybody to understand something that I think should be as widely understood as the public markets. You should know enough about the private markets, just as you know about the public markets. There's the stock market, there's the bond market, etc. You should also know about the private market. And the reason it's important is really three things. Number one, it's enormous. It's a $12+ trillion industry, well on the way, I think, to being a $20 trillion industry in the next decade or so. It's everywhere. It invests in, almost every sector of the economy. It's in a lot of niches you may not think about. It could be, private equity owns maybe the dating app that you use, could be the provider of your mortgage, could be your employer, could be your student loans holder. It could be, the folks who own your office building or your residential complex. It's really everywhere. And not just private equity, but also the other forms of private market, private credit, infrastructure, real estate, commodities, and so on. And so, this ubiquity of, private markets made me think, a lot of my friends don't know about it. They started to put their savings into it if they had the opportunity, but they didn't necessarily really understand it. So I thought, let's try to, look behind the curtain and tell people a little about what this industry is about. And, not only is it huge and kind of everywhere, but it's a great opportunity because I think if you look, not just today with choppy, jagged public markets, but if you look over time, should you be able to lock up a bit of your portfolio, however big or small, whether you're saving for retirement, saving for your future, should you be able to lock up some of your portfolio in illiquid assets that allow you to generate a better risk return trade-off in the long term? Maybe you should. Maybe you should look at 10, 20, 30, whatever the right percentage is of your portfolio in private markets. Not enough people know that. And as more retail products are being developed, I think it's important that people understand in advance what this industry is really like. And I'd say the third thing about writing the book was the importance of it is really, this is a people business. There's nothing automated about it. There's nothing that a supercomputer can replace. There's no trading involved. There's no algorithms. There's AI maybe in data gathering and analysis. But ultimately, it's judgment. Yeah. It's judgment. And even more so than in investment banking, which was a key part of investment banking, the best investment bankers I used to work for would tell me, Sachin, this business is about judgment. But it's even more so in private markets and private equity because you're dealing with other people's money. You're probably investing some of your own money as well. And it's long-term judgment. It's not a trade. You're not looking for that juicy bit of information, whether, you've got a better information set than somebody else. It's nothing like that. It's a long-term investment. It's a transaction. It's a trade long-term, but it's not a flip. And so because you need to understand the mindset behind private equity, that's pretty hard. It's almost impenetrable, right? And so I wanted to write a book that was easy to read, easy to understand, where people could use these case studies that we had to fictionalize for privacy reasons and so on, and really get a sense of what are the key principles that I've seen work very well in private equity that other people can learn from as they make their own decisions, whether it's about getting into private markets, getting into private equity, private credit, or it's about putting their money to work, or both. That was kind of the ethos behind it. What did I really take away from it? It's really interesting. I think there are a lot of lessons. One big one is that it's a really polarizing topic. You have a lot of people who either love it or hate it, right? And I don't really see it that way. I mean, I don't think that everything in this world should be, either perfect or terrible, right? Just like the media, just like journalism, just like, politics. It doesn't have to be that if you're right, I'm totally wrong, or if you're wrong, I'm totally right. There is a middle way of saying, there are some good things about this industry. There are some not so good things. And that's why in the case studies and the explanations we give, we talk a lot about mistakes that happen in private equity, how they can be fixed, right? And we try to give a bit of the good, the bad, and the ugly, as opposed to just saying, oh, this is either, a perfect industry, or wow, this is a terrible industry. Does that make sense?
Yeah, definitely. That's an interesting point. And I was listening to your conversation with Ted Seides, and you mentioned that private equity can do a better job of presenting itself, which I totally agree with. When I was in private equity and would tell some friends and family, I would also get some weird looks sometimes. So what do you think are some of the ways people in the industry can do a better job of presenting private equity to the world?
So I think there have been pretty big strides in the last few years in terms of transparency, encouraging diversity, and community impact. But I think there's a long way to go. I think if you look at the reach of some of these firms managing hundreds of billions of dollars, there's still a lot more that could be done to engage with the public, to engage with society. And I think that will help a lot. It's a slow process because, sometimes it feels that there are people who are just out to get this industry, right? Oh, it's all terrible. As you said, you encountered a lot of negative feedback when you're in the industry yourself. And so I'm sure they're trying to strike the right balance between engaging, possibly too much and becoming a target, and maybe on the flip side, not engaging enough. But I think they're all doing the right things. I think they just need to do a lot more of it, given the scale and reach of the industry. Better focus on successful case studies, which there are a lot of. I think that would make sense. But rather than necessarily saying, oh, we bought this, we improved it, we're amazing, we sold it, we're amazing. Just a little bit more color on here's what was better, not just for our investors, but for everybody. Here's what was better from this deal for society. I mean, small adjustments like that in the script, could probably help. But, as I said, I think they're getting there, but they're coming from a low base, and it will take some time to catch up, I think. If you look at the other way, are we being a little too unfair? If we look at large corporates, whether it's big tech or big pharma or big oil or big anything, are they all doing an incredible job of engaging with the public? Not always, right? And so I think we need to be a little bit balanced how we look at your question, but I still think that there is some catch up to do.
So for a long-term investment horizon, do you think private equity is the best asset class?
So I would never advocate, putting all of your eggs in one basket. I think the question is, we had an environment where people would think about 60-40, equities, treasuries, equity debt, 60-40, and maybe a bit of property, right? So, you maybe own your home and you put 40% here.
Let's rephrase the question. If I gave you $1 million right now, where are you investing it?
So the first question, whether you have $1 or $100 or $1 million, is how liquid do you need your assets to be? It's a really important question. And that's important not just because public markets are liquid and private markets are illiquid, okay? Many times public markets have an illusion of liquidity. It's liquid, but it's only liquid if you sell at a massive loss. That's not a great form of liquidity. And so it's still liquid, right? But you have to think really about how much of this money might I need in an emergency. And an emergency could be anything. It could be losing your job. It could be some other, really bad event. And so that's a fundamental question that I ask myself, and I try to plan in my family office. And when friends ask similar questions, I encourage them to think about. And that probably takes out a chunk of the $100 or whatever the number is that you're seeking to invest. And once you figure that out, then you start to allocate the rest. When government debt, when treasuries can make you 5%, or senior in private credit is making 10%, you probably should be doing a fair amount of that, right? Before you jump to do buyout. And so once you've figured out the part you can keep locked up for a few years and how long that period is, you start to look at, nesting, starting, the nest with, let's put some treasuries in, let's put some private credit in. This is making me a reasonably safe, or very safe in the case of treasuries, return. And I don't need to sell in a hurry. I don't need to do what some of the banks had to do, which is suddenly sell at a loss, right? I can hold it to maturity. Very important. I can hold it to maturity, even if the price moves up and down, and I can make a really nice return off it. And eventually inflation is coming down. So although I'm concerned about my real return, eventually it will catch up. It'll do well. And then you start to think about, on top of that, some hybrid. So hybrid capital, what are called tactical opportunities or hybrid value, or they're different forms. But, there's a lot of structured equity intermediates that give you some of the equity upside, but it's capped, or you give up some of it. But on the flip side, your downside is protected. That's actually a really attractive risk return right now. If you can get somewhere in the teens to 20% in IRR, but the possibility of capital loss is really low, that's a really good risk return right now. And I'm doing a lot of that.
Yeah.
And so, that probably takes precedence over buyouts, frankly speaking. But you might want to put a small sliver into buyouts. So you may have, if you know a lot about tech or you really like tech, you might want to put a sliver into private markets that do some tech. And once you've sort of gone through the capital spectrum, you've probably allocated another chunk of that capital, which can stay a little bit illiquid, right? And then you'd have some money, a third pot, which you put into public markets, where you're never going to be able to time it right? I mean, perfect timing. I'm not sure who has absolutely perfect timing, right? And so on that part, it may look liquid, but the reason I started with figure out how much you really may need in an emergency, you don't really want to sell that part at a loss, even if it's liquid, right? And so for that, you probably want to ask yourself if you really are a very good stock picker, if you really know what you're talking about, and you want to say, I want to buy this in Amazon or whichever company it happens to be, Apple or Disney or whatever, or whether you just want to ride the market and say, listen, I'm just going to make a 10-year bet, and I'm going to buy a very cheap ETF that costs me 10, 20 basis points to run with no performance fee. So these, I don't really give advice, but these are the questions I would ask, yourself. Yeah. And you can already see that there are quite a few questions. It's not just let me just stick it in this fund and think about something else. This is the money you've worked very hard to save. And so there are already a lot of questions you should be asking yourself. And the purpose of my book, 2 in 20, is really for you to start to think about that private markets part, whether it's private equity, whether it's hybrid, whether it's credit, and say, okay, let me understand this industry a bit better before I start to allocate some of my capital to it.
So I'm always curious how the world's best investors are investing their own money. So what does your portfolio look like, at least in terms of asset classes?
So everything I've just said is from what I've done myself. And so I tend to invest across the product spectrum from public to private and across the capital structure from credit through to intermediate to buyouts to infrastructure and property. I try to have a mix. I'm sure lots of times I get the mix wrong, but I try to have a mix of all these things because they have very different characteristics. Real assets, infrastructure, and so on. They, have different different risk return characteristics. In some ways, it's a hedge against other kinds of investments in the portfolio I've just talked about. But I try to build a bit of everything. And you might say, well, then how does everyone do that? Well, I'm not sure everyone can do it, but I think certainly the principles everyone can think about, which is, okay, I'm going to start off by buying my apartment. That's my real estate, right? I can control that. I can see it. It's my primary residence. In most places, your primary residence, when you sell it, is a tax-free investment in lots of places, right? So I'm going to have that's my real estate. And maybe as soon as I start to build some savings, I build some savings for a rainy day. Maybe I put some into some of the low risk stuff because I may need it. It's maybe shorter dated in maturity, right? And then as you start to build more savings, you play a bit more with this risk capital, with private markets, with intermediate, with buyouts. If you have a bunch of money that you can just park for 10 plus years, say, you know what, they're going to be year to year fluctuations, but I'm just going to put some money in the S&P long term. This is how, I think of these things myself. And this is how, I discuss these things with my friends too.
I want to talk a bit about private equity recruiting. I'm sure you're aware how crazy it's gotten these days with these investment bankers getting recruited in their first week or month on the job. What was private equity recruiting like back in your day?
So I was an investment banking analyst. I did it slightly longer than most of my friends who left after 2 or 3 years. I then did a program that promotes you to associate without needing to do an MBA. So I became an associate in investment banking. And, again, I was staying longer than most people just because I found it fun. And I was 20 still when I joined. So, at 25, I still felt I was learning a lot. And I was in the industry for years already. And so then I was approached by a couple of large private equity firms that had asked me about it a few years before. And I said, look, I'm having a lot of fun. I'm learning a lot. And I was approached by them. This is Morgan Stanley. And they said, well, would you like to come and join us? We've already talked about you internally. And there was a few offers like that came. And I think that still happens a lot. If you're working with, with sponsors, you can get that sort of tap on the shoulder of that request. And in my case, I remember it was some pretty interesting times. One was on a business trip to Saudi Arabia with a firm that had a great background in the defense industry. And we're looking at a lot of deals, flying between Washington and Riyadh. And, out of nowhere, I was asked this question by a couple of the partners of that firm, and it felt really good. And I was like, well, I got to talk about this. I got to have a chat to my friends. I got to speak to my parents. I got to, and then there were similar stories on other business trips in New York and so on. And in the end, though, I went with something very entrepreneurial, which was an outfit that came and said they were going to start a brand new sector, pretty much, that was pretty much a startup. Nobody had heard of them, and no one really believed anything they were saying. And it was infrastructure. And you'll see there's a chapter devoted to this in the book. No one really took them seriously. And it's turned out to be an enormous, highly successful industry. And they're very much, I think, in my view, the forefront of it and the creators of it. And I did that with them, and they were offering equity very early on, and that was quite rare at the time. So I ended up going with something very entrepreneurial, and then ended, after 5 years of doing that, gravitated back towards the major firms, which were, perhaps better known at the time.
Yeah, and for the record, I found that chapter really insightful. I don't know if you know Sachin, but I worked in infrastructure private equity, and I had no idea about the background. So I found that
it's pretty amazing. I remember. Yeah. I got a kick out of writing that part. I remember still going into they couldn't even get meetings because they would get meetings because I was the analyst or associate with the counterparty on some deal as a junior advisor. They'd be like, oh yeah, I remember that guy. Yeah, sure. We'll see what he wants to talk about. He's joined some outfit. We've never heard of them.
By the way, how are they doing right now? Are they just absolutely crushing it and had like a 10x or something on their last fund?
I haven't followed the fund to fund, but I think they're pretty much recognized as the pioneer in that industry, if not one of the pioneers. And I think they're doing very well. Although I'd say my personal view is that they have a lot more growth left, particularly in the US. But yeah, I mean, look, that was a fun chapter to write, and that was a fun experience to see them. And they made their share of mistakes, of course. But overall, it was a pretty successful entrepreneurial thing. And then later, as I said, I did towards the other sort of firms that you and your audience have probably heard of a bit more, in doing distressed buyouts and other things like that.
I want to talk a bit about the private equity investment process. As a former private equity associate, I've spent countless hours in Excel building these huge operating models from the ground up. At times, I felt like there was a little bit too much focus on the model and its assumptions. Sometimes there were so many assumptions that it almost felt like garbage in and garbage out. There were also times that I felt like we were back solving for returns than the other way around. In your investment process, what matters the most to you? Is it the returns in the model or something more qualitative like the management team?
So that's a bunch of questions in one. I'll start by saying I've never had the experience you've had of reverse engineering to return. And in a really good private equity team and a good private equity firm, good asset management firm, that never happens. It's about getting to the truth of what's really happening in the business. Really trying to understand how the money is made, the flows, the strategic positioning, whether that business needs to exist, what you need to believe to create value. Very serious, heavy questions that take serious, heavy work and a lot of data.
So, Sachin, I have a question.
If you don't know the answer as well, you move on.
So there are some assumptions which, I mean, to be frank, we can't really predict what's going to happen, 5 to 7 years from now. For example, the CPI assumption you put in an operating model, if it's 1% versus 2% versus 3%, that can have a huge impact on the model, right? How do you balance all this information and make a decision?
Right. So it's a great point you're mentioning. So I'm not sure you ever want to bid on a super stretch case, right? Where it only works if all the stars are in perfect alignment and, you have to price it to perfection. That doesn't really make sense, right? You want to bid on something, whether it's a competitive process or not, with somewhat, some conservatism, some room. And, ultimately, this is just the way I was trained, that, the purchase price matters, the valuation matters. The less you pay for something, everything else equal, the more room you have for mistakes. So you're looking for a smart bargain. Now, that doesn't mean cheap. A smart bargain could still be a high price, but relative to growth that you've done your best to diligence at least most of, it's a good deal. It's a smart bargain. So I'll give you an example. So there was a cable TV operator, a deal I originated, one of the first deals I originated. And, I really brought this deal to the team that I was working as part of at the time. There weren't many like that. Many times it was, someone more senior who'd originate the deal, or it came through an advisor or something. But in this case, it was my idea and my origination. But the price looked crazy because it was a very high EBITDA multiple. The trick was to realize the company was growing at 20, 30% every year, and to underwrite that and to believe it sufficiently that on a growth adjusted basis, the purchase price looked like a smart bargain. That was very difficult to do. And it involved a lot of diligence. We got plenty of things wrong, of course, but we got more things right. And although the first couple of years of the EBITDA evolution were not exactly as we planned, and we had to hold the investment slightly longer, ultimately, it was a 4X, I think. And it was a terrific deal in a great jurisdiction because the fundamental thesis of that growth was correct. It would just move slightly differently, and nothing moves exactly according to the spreadsheet. Spreadsheets are a guide.
Yeah.
And so
Right.
it's about making sure that the fundamental of your investment thesis is more or less correct, right? And ideally much more correct than incorrect. And that you have enough operational levers, you have enough room in the purchase price, you have enough maneuverability, and critically, you have a fantastic team, either at the company already or you can add to it, change it, that can execute on that. I mean, it's all these ingredients together. And that's why, going back to one of the earlier questions, I really wanted to get into investment banking because I wanted to get close to these kinds of decision making. But you can't just jump into being. You have to start, I think, by learning how to be an advisor, how to consult maybe, and then gradually realizing whether being the principal taking the risk of those decisions is you. Is that your personality? Is that who you are? And so I kind of look at all of those things together, and it hasn't really changed from working in a big firm or running the family office.
Yeah, and just taking a step back, I am curious, what is your personal research process like? So, for example, there's an industry out there or there's a company out there and you want to just know more about it. What do you do to learn more about it? Do you call your friends? Do you research the internet? What does Sachin's research process look like?
So you do all of that, but most important, you speak to people. Of course, if you don't have the data, there's nothing to model, right? You can't just model feelings and perceptions and so on. You have to model data. So the modeling comes from all the sources you would expect, public sources, private sources, depends on the deal, depends on the situation. And, if you're a Bloomberg subscriber and you have access to the right databases, you're in diligence on deals, you'll get pretty much the data you need. But like I said, it's a people business. And so absolutely key is meeting the individuals. And now, as I'm an LP in many firms and many funds, that has been the most interesting, actually, is to be able to think about, okay, well, that firm is doing that in that fund. That firm is doing that in that fund. Interesting how I learn about perspectives from them, and then draw on those perspectives when you meet people in the deals you're doing directly. Does that make sense? That's absolutely key, because you have to get the confidence that the people you're talking to can make those numbers work. Because, you should never confuse yourself with management. They have an incredible job to do, influence on the outcome. And so the most important is really the people interaction. And I don't just mean the C-level, speak to the chair, speak to the C-level. I also mean the next 1, 2, sometimes 3 layers down, because that's where often the hardest work is done, right? And really meeting the working teams that do all the work in between the board meetings. That's critical.
I know you're invested in a bunch of funds now. Would you say life is easier as an LP than it is as a GP, or how would you compare those two?
Well, I do a bit of both. I mean, I like to have a mix of very active investments and more passive investments. My palette is broader. I look at more industries. I'm doing more in tech. I'm doing more in pharma. I'm doing more in data centers, more in real estate. I didn't do all of those things when I was working in one job for a big firm. So I think in many ways it's much more difficult. What is nice is being more in control of your own schedule and, working for yourself. But, this entrepreneurial side to it, I think I could only really have attempted if I had had the background of a couple of decades, working in professional services.
So I want to switch gears a little bit and ask a few non-finance questions, if you will. So what makes Sachin Khajuria truly happy?
So a very good balance of life between family, includes, elders, parents, uncles, aunts, kids, home life, friends. So very good balance of being able to pay enough attention, enjoy, participate, serve, with professional life. So everything we talked about as an investor, which is my main job, And then, to a certain extent, the author side of things and the marketing that goes with that, and the podcast, the speeches, the talks that come with that, and just life enhancing pursuits. Growth is kind of the third part of the pie chart, and that includes travel, sport, education, taking courses. It's hard. It's hard to, when you're in a full-time job, it's hard to get all these three things going as well as you'd like, right? Because one probably dominates, and it's probably the job, right? And so having that balance of being able to do family, career, and life enhancing growth kind of pursuits is amazing. Picking up new sports, learning to fly, reading much more than I ever used to. Certainly during my private equity time as a partner, I'm reading a lot more now. This balance is really key to me.
And do you think this has changed over time, where certain things that you thought would make you happy don't make you happy anymore?
I think you have different priorities as you grow up, right? In college, you're learning about the subjects you've chosen. In your early stages of a job, you don't know anything. You're learning how to do a good job. You probably still don't know that much after 5-10 years. You're still growing. And so I think as you start to harvest some of that after a couple of decades, maybe, you can start to, develop other parts. So I think I think all these things are important, but sometimes you have to focus more on one part of it to get it going. And, certainly, I remember my first 3 years as an analyst, I don't think I had a single day off. It was 365 times 3. Seriously, it was insane. Yeah. I'm not sure that's still the case in investment banking, but back then, it was, there was no mandatory leave. It was mandatory stay. So I think you have to focus on what's going to get each part of this balance going. And as you get older, you're able to rebalance it a bit if you're lucky enough.
Some of the most successful people that I have met or read about are people that are constantly seeking knowledge, are people that are constantly making themselves better. What is your goal over the next 5 to 10 years? What do you want to get better at?
So it's only been about 5 years that I've started investing in some of these newer areas I hadn't done previously. I want to get better at doing it. That takes, you can't just say, I'm doing more in tech or I'm doing more in pharma. I originated some pharma stuff in my old job, but, I'm doing a lot more of it. I'm doing more in data centers. You can't just say, well, I've done it for 5 years, I'm an expert. I mean, that's just, and you really want to develop a really good ability to sort of know more sectors and continue to grow and develop. And, I'm curious. So if you're curious, you learn more and you spend time because you want to, it interests you. So I think that's pretty big. I also think just doing more fun things in life, doing more sports than I've ever done before, reading more than I've ever done before, maybe take another degree would be really nice. I have the time to do that part-time. I sort of feel like there's so much more to do in life than Excel. So, you want to really live the fullest. And so, and a big part of that is travel. I mean, I'm not sure I'll take a sabbatical and go around the world or something like that, but, there's plenty of ways to spend a lot of time in individual countries I really like that I just haven't spent enough time in. And I'd like to do not just 1-2 trips to those places, but like 10, 20 trips, And so I think it starts with the center of my day, which is, my career, which is really trying to push knowledge and get competency in, the areas I've only been doing for 4 or 5 years, and bring those up to speed. And it grows from that to all of these other pursuits. And then, as I mentioned before, when we talked about balance, it's, also about being, fully there for family and participating fully, which, takes more time as you get older.
What are some of the places that you want to spend more time in? As a digital nomad myself, at least for the last 2, 3 years, I've had the fortune of visiting places and actually living in a bunch of places that I always dreamed of. What are some of the places you want to spend more time in?
There are so many, honestly. And so it's
Life's
really,
too short to go to them all.
yeah, it's tough to prioritize. I think I really want to spend some time in New Zealand. I've been several times to Australia. I want to spend more time in parts of Australia I haven't, but I really want to spend time in New Zealand. I've been to Japan a few times. I really want to spend more time there. I think for sure there's a lot of India I haven't seen. I tend to go to the same places all the time, and so I want to diversify there a bit. A couple of the countries around India, Nepal, Bhutan, really beautiful places would be great to see. Turning to the west a bit. I've not spent that much time in South America, and so Brazil and Argentina, Chile, Peru, these are on my list. I haven't spent enough time in those places to know whether I want to go many times, like I do with Japan and India, for example. But I do want to spend more time there. I've seen most of the states, and so I'm there a lot. I love Canada. And I've spent quite a lot of time on the two coasts, east and west, but I probably want to go to the west coast again. I really like Vancouver and, going up towards, the west coast there is really nice. And these are all reasonably long distance from my base, either in Switzerland or New York. But within Europe, I would say I'm a big fan of two countries in particular, in addition to Switzerland, France and Italy. And it's like so close, right? From Zurich or from London.
Where exactly?
You can get. So I would say in Italy, it's probably all the places the Amalfi Coast, Rome, down in the south. In Sicily, but it's like to really spend a bit more time there, rather than 3-4 days, so that sort of thing. So I know this is a very long list, but these are all the places I want to spend time.
So I visited Amalfi Coast about a month ago, and I thought it would be a good time to go when no one's around. It's winter time. It was the worst time to go there. Literally every restaurant there was closed. There was one place that was open. It was rated like a 3 out of 10 on Google, which, by the way, is an achievement because no other restaurant in the history of restaurants is rated that low. It was the worst food of all time. And I was just like, wow, I need to get out of here. I was there for 4 days, and it honestly felt like a lifetime. So if you're planning to go there, for all the listeners out there, do not go there in the winter. It's the worst thing you can do in your life. I do want to come back to some of this advice for all the people that are listening. What skills and habits do you think one should, and if you don't mind, just separating it out, what are skills and habits one should learn in their teens, in their 20s, 30s, and beyond?
So I think one skill or habit, just trait that goes through the years is curiosity. It's really important to be curious, to care. Like I want to know, as opposed to I don't care. This curiosity it really leads you to a lot of great places when you have an interest and you're curious about it, and you'll naturally learn. So that I think is kind of evergreen. And I'm going to take for granted all the basic stuff that we should all try to have as people, right? To work hard, do the right thing, and have the right, sense of justice and values and all of that. But kind of skills and habits, I think in the teens, looking back now, it's been a while, very good work habits. Because you're probably doing a lot of exams, I guess, in your teens and early 20s. And really good work habits, being organized, sticking to time on time tasks, researching efficiently, reading efficiently, spotting information, all of the things I guess that, pretty much all students need for a good, academic career in their teens. And on top of that, being really active, because I found that one of the best things I did in starting my family office was to be much, much more active, not just to get in better shape, lose weight, and all of that. Yeah. It helped me think so much better. And being active, staying active, it almost, I guess, doesn't really matter what the activity is, whether it's some mixture of weights or some sport you like or whatever. These are really key, because if you don't build them, I think, in your teens, it's quite hard to, maintain at least some in your 20s. And in your 20s, I guess, one thing that I was constantly told by people I used to work with and work for was, you're very much in the weeds when you're an analyst, when you're an associate. And you have to take a few moments every week. And I tried to do this once a week, to take an hour to step back across all my deals. It was very hard because I didn't have many spare hours. But I tried to step back and just say, okay, let me step back and work on these 5 deals, or whatever the number is. Let me give 10 minutes per project. Okay, that one's a JV. So, it's a bit like a marriage. How do they get in? How do they get out? Liquidity is an issue. Let's ask my seniors about that when I get back to the office later tonight or tomorrow or whatever. This deal is leveraged finance. It's already a highly levered company. They want to overfund the interest. So they're borrowing the interest on top of what they're borrowing. Okay, let's look at more extreme downside scenarios. What could happen to this thing if it goes distressed? Okay, this is a merger. It looks, the accretion dilution makes sense and it's accretive, so they want to do it. Let's really drill into those synergies which are making it accretive. Kind of stepping back, right? This deal is about a combination in this industry that will create these benefits for consumers, the companies themselves, and so on. How could that industrial landscape look several years down the line, right? And so there are lots of different questions you ask yourself when you step back. And that really helped me in my 20s transition from just analyzing the numbers to thinking more and more about the business and the business case of whether it really makes sense for the clients to do what they're doing. Do you see what I'm saying? And that's obviously the question that people ask when they're, running case studies by you when you're interviewing for private equity, is to see, well, what would you do in this deal? Would you do this deal? What are the questions you would be asking yourself? And then, of course, as you get beyond 30s and so on, it's a lot more about originating and leading and teaching the next generation. So I hope those are useful points for your audience to think about.
How much money do you think does it take net worth wise to be comfortable in the United States or the United Kingdom?
I mean, that's a very broad question. I think the truth is, what do we all really need? You need a place to stay. You need to be able to provide for your loved ones if that's, part of your role. And you need to eat, exercise, and hopefully, travel reasonably well. Not much. Do you really need?
But I feel like we're also all, working in finance, and, I agree with you that that's all it takes. But sometimes there's a figure in our head that just makes us feel like, if we get there, we will be comfortable.
Well, you're probably reverse engineering into that figure because you think, I want this, it costs this, I want this, it costs this. But a lot of those things I really think are transitory. I got to drive this car. I got to live that house. I got to have this chalet. I got to have that beach property, blah, blah. Eventually, I think you'll cycle through it and you'll get to a stable base of, what you really, really want and what you really, really need. And that's a lot smaller than I think most, people might be worried about. I mean, one interesting lesson I was told when I started my job as the first week, and it was by the head of investment banking. at the bank at the time, and he said, what do you want? What are you doing this for? You're going to earn some money. You're going to learn a lot, develop your brains, develop your careers. What do you want? And no one really thought, okay, I want to buy this or I want to buy that. It was, yes, you want to live well. Of course, everyone wants to live well, but I don't really look at it that way of, I need this number, or I'm just not that kind of person. I guess my parents used to say, make a long list of everything you really, really want and give yourself 25 years to go and get it. And along the way, you'll probably find that list changes a bit, and it might grow a lot at the beginning because I want this and I want that. And then as you get a bit older, it's going to get a lot shorter. It's like, I don't really need this and I don't really need that.
Yeah.
So I always like that bit of advice, which is make a long, and give yourself 25 years. So you start work at 25, give yourself to your 50 or whatever the number is for you, whatever works for you. But I've certainly found over the years that my definition of what, one really needs is we all don't need that much. The problem is life is expensive. So to live in a decent place and live well and eat well, that costs money. And so that's why you want to save for your future. And that's why you want to learn about private markets. You want to learn about public markets. That's why you want to learn to invest, because ultimately I really feel that investing is a skill that everybody should have. Mm-hmm. If you're a doctor and you've got savings, you should have some investment acumen to know what to do with it. Even if you don't do it yourself, to at least understand what people who are doing it on your behalf are really doing, right? You're a property guy and you invest all of your money in, buy-to-let properties or developing commercial properties. Great. But also understand, what do you do with all that hard-earned cash you're going to earn over the course of your career? And so I look at investing as a skill that I hope everybody learns to the extent that they're, interested and able to. And that's why I wrote this book, because it's really about the democratization of finance.
Yeah, that's really great advice. And I would recommend everyone listening to go check out Sachin's book, 2 and 20. It's a great book if you want to learn more about private equity, and even if you work in private equity. So Sachin, you've lived the ultimate dream for a lot of finance people out there. You were a partner at one of the best private equity funds in the world. You run your own family office now. You have a published book. What's your goal for the next 10 years?
So you want to stay healthy, you want to continue to grow, and you want to contribute to the causes that matter to you. Staying healthy, I think, as you get older is increasingly important, right? You got to try to eat well, try to exercise, all those things. I really want to grow. I really want to continue to learn how to invest in things that I haven't historically done. I'm not sure I'll become an expert in any of them, but just become competent in them and have them complement the things that I, kind of do almost like second nature now in the sort of investing that I've done for a long time, and contribute to the causes which are important, which to me is, very much family. And, I've done a fair amount of philanthropy, and that's going to grow. It's probably for me going to be to do with things like medicine and education. Those are probably two of the causes I believe in the most. I've also done a fair amount with, charities to do with the homeless and people who are in tough circumstances. So I'd like to sort of achieve in all these spheres and just go forward. And that's really goes back to the question you asked earlier, and I mentioned the key thing is balance. I want to push all these forward. But it's tough, and it means that you have a very busy day and you have a very busy agenda. And it makes me really happy that the range of things that I'm investing in now is just so much diverse and interesting and better hedged than, when I started doing this, 2018 or so, for myself. And it makes me really happy that, the charity causes we're involved with and the way I can support family and do other things that are important to me. I have time and resources to do it, which I didn't really have before, right? So I think that's probably how I'd summarize it now. I'd quite like to see a live action version of 2 and 20 as well at some point. And, probably we've only used about 5% of the real case study content we have. So I'm sure whether it's a Netflix series or a movie or something, there could be a really, really interesting live action treatment of some of the 2 and 20 material. So that's something we're thinking about, and we'll probably give more thought to after the book has been out for a full year.
Yeah, I think that's a great idea. There are plenty of shows on investment banking, but not any on private equity that I know of. Well, switching gears a little bit, I want to talk about health. So I recently turned 30 and I'm waking up these days and random parts of my body are hurting. Maybe I'm overreacting, but I want to know what your workout regimen is like and if you've learned any health tips or hacks over the years.
I'm definitely not the expert on any of that, but I think friends of mine.
I mean, you look 30. You look 30. When I had to see your picture and you in this video chat, you look very young.
Oh, thank you very much. But you're making me blush. The friends of mine who work out a lot have told me, and I did martial arts for 7 years or so. I got only one, but I got a black belt in kickboxing. And I stayed very good friends with all the instructors, and they said, listen, there's a lot of very basic exercises that you can do, which are free, that really will transform your fitness if you do them well. And it seems really simple, but like push-ups, sit-ups, plank. If you can do push-ups, sit-ups, plank every day, and make a good 30-minute routine out of it, it's not as easy as you think, like real push-ups. And so, I try to sort of do very basic things, but do them very, very often. And, I picked up tennis in the pandemic as a sport. And so I do a lot of that. And so, I think it's a combination for me, and this is by no means probably great advice, but for me, it's a lot about doing simple things, but doing them a lot. And also doing sports that you really like, because those are the ones you're going to want to get out of bed for. The weather's mixed, but you still really want to play, right? Or you're tired after a flight, or there's something else that's making you cranky or something, but you really want to go out and play. So, we will have a sport or two that we really like, and I would push that to the absolute max that your body is able to, healthily and safely, and do a bunch of basic exercises. It's the same with weights. Like, there's a couple of friends of mine who are instructors at these sort of cycle studios and Barry's boot camp type studios. And they say, you know what, just keep like 4-6 dumbbells at home, but religiously do these 6-12 exercises every day if you can. And if you can't, at least 5 days a week. After a few months, it really builds up, because probably sitting at a desk doing Excel, you're not doing, well, if you're sitting at a desk doing Excel, you're not doing much of that, right? You're going from one meeting or lunch to another. And so, I don't know, baby steps, small hints. I don't know if they're helpful, but that's the truth about what's to be working for me.
Yeah, that's a great point. And with working out, it's all about the consistency. Honestly, it doesn't really matter what you do as long as you do something every day, whether that's waking up in the morning and doing 10 push-ups and 10 sit-ups. It's way better than going to the gym once a week and trying to lift every possible weight in 3 hours. By the way, I'm a huge tennis fan as well, so we definitely have to play whenever you're in town.
Yeah, no, let's do that. I'd love to do that. And I'm absolutely thrilled to hear that. I've not been doing it for very long, so you're probably way ahead, but I love playing.
Have you gone to the US Open? Maybe you should come by around August time. I think that's...
Yeah, well, I'm in Europe about half the time, so I'll try. Let's try and do that. Let's try and set that up.
Okay, perfect. So at the end of this, we do a few rapid fire questions. Are you ready?
Go for it.
Okay. London or New York?
New York.
Public or private markets?
Private.
If you could switch lives with anyone for a day, who would it be?
Mahatma Gandhi.
Favorite book?
The Culture of Contentment by J.K. Galbraith.
It's not 2 and 20?
No, it's not.
Best private equity firm?
Blackstone.
Sachin, this has been a lot of fun. Thank you so much for taking the time. I know we've tried to schedule this for a long time, but I really enjoyed it. Thank you so much.
Thank you very much. It's been a real pleasure. I hope your readers enjoy 2 and 20, How the Masters of Private Equity Always Win. It's published by Penguin Random House in all formats, ebook, audiobook, which I think is great. I really enjoyed the voice actor who does the audiobook, and of course hardback. And if any of your audience would like to engage further, either on the book or more generally, very happy for them to contact me through you. And it's been a real privilege to speak to you today.